In 1994, a 35-year-old engineer named William put $100,000 into a dividend stock portfolio yielding 4.2% annually. His neighbor James put the exact same amount into a total market index fund. By 2024, 30 years later, one of them had $1.1 million. The other had $2.3 million. The one with more money wasn't the one you'd guess. Which strategy actually wins over 30 years? And why does the math contradict what most finance content tells you? But here's what's more important than the final number: the conditions under which the losing strategy would have won. Because there is a specific market environment, one that many analysts now believe is quietly forming, where the dividend approach does more than just keep up. It protects wealth in a way index funds structurally cannot. What is this specific market condition, and are we in it right now? Here's the problem with every dividend versus index fund video you've ever watched. They almost all run the math in a vacuum. Total return here, yield there, final portfolio value, done. And usually, the index fund wins. So they declare it the victor, you subscribe, and everyone moves on. What almost none of them model is tax drag on dividends and a taxable account compounding for 30 years. When you account for that single factor, the gap between strategies doesn't just change. For many investors in the 22% or 24% bracket, it reverses who's winning in the first decade. Institutional investors know this, which is why the largest family offices and endowments, the ones managing $500 million to $5 billion, don't hold dividend portfolios in the way retail investors are told to build them. They hold them in very specific structures, for very specific purposes that have nothing to do with monthly income. And then there's the second thing nobody models honestly. The mainstream narrative frames this as a performance debate. Which strategy grows your money more? That's the wrong question. The question that actually determines retirement outcomes is, which strategy survives the worst sequence of returns at the worst possible moment, the decade you retire in? That is a completely different analysis. And the answer is not what the index fund community would have you believe. We'll get there. But first, you need to understand why the standard 30-year comparison is missing 3 structural layers. Let me show you the actual numbers first. Not approximations, real data modeled from 1994 to 2024. Portfolio A, $100,000 invested in January 1994 in a dividend-focused strategy, roughly approximating what today we'd call a high dividend EXIF. Average dividend yield of 4.0%. Total annual return, dividends reinvested, approximately 9.2%. Portfolio B, $100,000 in the S&P 500 Total Market Index, fully reinvested. Average annual return, approximately 10.7%. 30 years later, at identical $100,000 starting points, Portfolio A, approximately $1.112 million. Portfolio B, approximately $2.31 million. That's a $1.19 million gap. Over $1.1 million of difference between two people who both invested $100,000 in 1994 and never touched it. Now, most investors misunderstand what this gap actually means. The gap isn't because dividends are bad investments. It's because of a compounding mechanic called dividend drag. The idea that when a stock pays you a dividend, its price drops by exactly that amount on the ex-dividend date. You don't get the dividend in addition to the price. You get it instead of price appreciation that would have compounded untouched. This is not controversial. It's accounting. The total return of a dividend-paying stock is identical to a non-dividend stock with the same underlying business, before taxes. After taxes, it's not. Here's why that matters for you specifically. If you hold dividend stocks in a taxable brokerage account, not a Roth, not a 401k, a regular account, every dividend you receive is a taxable event. Even if you immediately reinvest it, the heirs has already taken a cut. Qualified dividends are taxed at 15 to 20% depending on your income. Ordinary dividends, and a surprisingly large percentage of dividend ECF payouts are ordinary, are taxed at your marginal rate. For someone earning $100,000 to $180,000 annually, that's 22% to 24%. Let me quantify that drag concretely. On $100,000 generating 4% annual dividends, you're receiving $4,000 per year in dividends. At a 22% tax rate, you lose $880 in year 1. That $880 doesn't compound over the next 29 years. At 10% annualized growth, that $880 would have become $15,700 by year 30. Multiply that effect across 30 years of dividends, with a growing portfolio base, and the cumulative tax drag, properly modeled, accounts for roughly $180 to $240,000 of the $1.9 million gap. Now here's where the smart money diverges from the retail playbook. High net worth investors and family offices who want dividend-like income, regular cash flow from their portfolio, don't buy dividend stocks and taxable accounts. They use a structure called systematic withdrawal from a low-cost index fund, combined with tax loss harvesting to manufacture what looks and feels like dividend income, but is treated as capital gains, taxed at 0%, 15%, or 20% instead of ordinary income rates. The strategy is called a total return withdrawal approach, and it's been the preferred structure for sophisticated wealth managers since at least the early 2000s. Meanwhile, retail investors are told to live off dividends in retirement, which sounds elegant and psychologically comfortable. No selling, just collecting. But the mechanics are brutal for taxable account holders. You're not in control of when dividends arrive. You're not in control of how much, and you're paying taxes on income you may not have needed that year, which disrupts your ability to control your effective tax rate across retirement. Now, I want to be completely fair here, because this is where the analysis gets more nuanced, and the dividend case gets meaningfully stronger. Inside a tax-advantaged account, a Roth IRA, a traditional IRA, a 401k, the tax drag argument completely disappears. The dividend is reinvested with zero friction. In that environment, the performance gap between a high-quality dividend growth portfolio and a broad index fund narrows dramatically. Historically, depending on the time period, the gap can shrink to under 1% annually. Sometimes, the dividend portfolio wins, and there's a specific type of dividend portfolio that performs differently from the generic high-yield ETFs most people use. There's a difference between high-yield dividend investing, chasing the highest payout, often 5 to 8% yields, and dividend growth investing, buying companies that raise their dividend every year regardless of market conditions. The data on this distinction is striking and underreported. The dividend aristocrats, companies in the S&P 500 that have raised their dividend for 25-plus consecutive years, have delivered a compound annual return of approximately 12.3% from 1990 to 2020. The broader S&P 500 returned approximately 10.7% over the same period. Dividend growth beat the index. Dividend yield lagged the index. That is not a subtle distinction. It's the difference between buying AT&T in 2010 for its 6% yield and watching it lose 30% of its principal over the next decade, and buying Johnson & Johnson for its 2.8% yield and watching it raise the dividend for 60 consecutive years while compounding your wealth at 12% annually. Here's the structural factor that almost no one models correctly, and it's the one that makes the entire debate more complicated than either camp wants to admit. Sequence of returns risk. The idea is simple, but the consequences are devastating. It doesn't matter what your average annual return is over 30 years if you experience a catastrophic loss in the years immediately after you begin withdrawing from your portfolio. Let me give you two retirees. Both earn a 7% average annual return over their 20-year retirement. Both started with $1 million. Both withdraw $50,000 per year. Retiree A has bad years early, loses 30% in year 1, 15% in year 3, recovers strongly in years 10 through 20. Retiree B has great years early, gains 25% in year 1, 20% in year 3, then has the exact same bad years in the back half. Same average return. Same withdrawal rate. Same starting balance. Retiree A runs out of money at year 17. Retiree B finishes with $2.3 million. That is sequence of returns risk. And it's where dividend stocks, specifically dividend growth stocks, have a structural advantage that index funds simply do not have. Here's why. When markets crash 30 to 40%, as they did in 2000, 2008, and 2020, an index fund investor who needs income has two choices: sell shares at deeply depressed prices, or stop spending. Selling depressed shares is the mechanism that destroys retirement portfolios. You're permanently locking in losses and reducing the share count that would have recovered. A dividend growth investor in 2008 experienced the same 40% drop in portfolio value. But Johnson & Johnson, Procter & Gamble, Coca-Cola, and 30 other dividend aristocrats raised their dividends that year. The income stream didn't fall. The investor didn't have to sell a single share at the bottom. 15 years from now, when you are pulling money out of your portfolio in retirement, the question will not be which strategy grew faster. The question will be, did I get unlucky with my retirement date? A 2007 retiree with an index fund hit one of the worst sequence of return scenarios in modern history. A 2007 retiree with a dividend growth portfolio had a meaningfully better experience, not because the portfolio was worth more, but because the income held. Now we arrive at the piece of this analysis that is most relevant right now, in 2025 and 2026, and that most dividend versus index content completely ignores, because it requires a macro perspective most retail-focused creators don't maintain. The 40-year tailwind that made broad index investing the dominant strategy is structurally weaker than it was. From 1982 to 2022, falling interest rates were the single most powerful factor inflating equity valuations. As rates fell, the present value of future earnings rose. Price-to-earnings multiples expanded. The S&P 500's PE ratio went from roughly 8x in 1982 to over 25x by 2022. That multiple expansion added enormous returns to index investors that had nothing to do with business performance. It was a one-time gift from a 40-year macro tailwind. On the surface, the index fund looked like a superior investment vehicle. At the structural level, it was a beneficiary of a once-in-a-generation bond market. You are now investing in a fundamentally different interest rate environment. The tailwind may be gone. It may even become a headwind. In a higher-for-longer rate environment, which several macro strategists, including those at JP Morgan Asset Management and research affiliates, now believe is the base case, dividend growth stocks historically outperform the broad market. Why? Because when discount rates are high, the market reprices long-duration growth stocks harshly. Companies trading at 40x to 60x earnings, the kind that dominate index funds today, get crushed when rates stay elevated. Companies with pricing power, real earnings, and growing dividends hold their value. This is not a permanent structural shift, it's a regime. And regimes last long enough to matter for your 10 to 15-year planning horizon. At this point, you have the surface math. You have the tax architecture. You have the sequence of returns framework. And you have the macro regime context. But I haven't told you the thing that surprised me most when I ran this analysis. The finding that genuinely changed how I think about this question. It's not about which strategy wins in isolation. It's about what happens when you combine them, and the specific ratio at which the combination produces outcomes that neither strategy achieves alone. There's also a third risk factor, hiding inside broad index funds, that almost no one in the personal finance space talks about. A concentration risk that has been quietly building for the last decade that makes the historical index fund data less predictive of the next 20 years than most people assume. If you're 30 years old building wealth, or 50 years old protecting it, the next 10 minutes will be the most structurally relevant part of this video. Stay with it. Here's the thing about index funds in 2025 that 2005 index fund data doesn't capture. When you buy a broad S&P 500 index fund today, your money is not spread across 500 companies in any meaningful sense. The top 10 holdings, Apple, Nvidia, Microsoft, Alphabet, Amazon, Meta, and a handful of others, now represent approximately 33 to 35% of the entire index by weight. You are buying a concentration bet whether you intend to or not. Historically, market cap weighted indices worked because no single sector or company dominated enough to introduce idiosyncratic risk at the portfolio level. That mathematical assumption has broken down. In 2000, the top 10 holdings of the S&P 500 represented about 25% of the index. In 1990, it was closer to 17%. Today it's 33%, and all 10 of those companies are in the same macro risk category: technology, high PE, highly sensitive to interest rates, highly sensitive to AI capital expenditure cycles, and heavily dependent on the same global advertising market. That is not diversification. That is a highly concentrated technology allocation wrapped in the language of broad market exposure. Most investors who believe they own the market actually own a leveraged technology bet. If you understand this, you're already operating with more clarity than the majority of retail investors who are confidently just buying the index. A dividend growth portfolio, by its nature, cannot be dominated by a few massive technology companies. Companies at 60x earnings rarely pay dividends, and when they do, the dividend is too small to be relevant. Dividend growth portfolios are structurally diversified across sectors that generate current cash flow: healthcare, consumer staples, energy, utilities, financials. This doesn't make them superior in every environment. In a raging bull market led by technology, you will underperform. But it does mean your sequence of returns risk is distributed across sectors with genuinely different economic drivers, which is what diversification is actually supposed to accomplish. Here's what the data actually supports when you stop treating this as binary. The optimal portfolio structure for most investors between 28 and 55 is not a choice between dividend stocks and index funds. It's a staged allocation model built on 3 principles, and the ratio shifts based on your timeline. Principle 1. The accumulation phase, roughly age 22 to 45. Favor broad market index exposure at a heavy weight, 70 to 80%. The math on long compounding periods strongly favors total return. Tax-advantaged accounts should hold any high-yield income positions. Dividend growth stocks, if held, should represent 20 to 30%, held for their behavioral anchor function as much as their returns. The behavioral anchor function is undervalued and undermodeled. Research from behavioral economics shows that investors who can see growing dividend income in a portfolio are significantly less likely to panic sell during market crashes. The psychological comfort of my income went up even when my portfolio went down reduces the most wealth-destructive behavior in investing: selling at the bottom. Principle 2. The transition phase, age 45 to 60. Begin shifting the allocation toward dividend growth specifically, not high yield, at 35 to 50% of the portfolio. This is the phase where sequence of returns risk begins to matter. You have 15 to 20 years of compounding left in your favor, but the consequences of a catastrophic early retirement sequence are starting to become relevant. Target companies with 10+ consecutive years of dividend growth. The dividend aristocrats and dividend kings lists are reasonable starting filters. The goal is not maximum yield, it's income stability under market stress. Principle 3. The distribution phase, age 60 and beyond. The distribution phase is where the naive index fund always wins argument breaks down most severely. In accumulation, you're adding money. Compounding works for you. In distribution, you're subtracting. Compounding can work against you if returns are sequenced badly. At this stage, dividend growth investors have a structural advantage: a growing income stream that doesn't require selling shares. But total return investors can replicate this with systematic withdrawal strategies, with the critical caveat that this requires discipline and a cash buffer that most people don't maintain. The specific market condition where dividends structurally outperform: a prolonged period of elevated interest rates combined with flat or declining PE multiples. A valuation compression regime. In that environment, the yield component of dividend stocks becomes a larger fraction of total return at the same time as the multiple expansion tailwind reverses for growth stocks. The 1965 to 1982 period is the historical analog. In that 17-year stretch, high-yield, high-quality dividend portfolios massively outperformed the S&P 500 on a total return basis. Whether the current macro environment becomes that analog is not a certainty. But it's a structural scenario serious enough to warrant positioning, not a dramatic portfolio overhaul, but a deliberate tilt. So who won the 30-year math? In the baseline scenario, taxable account, both strategies fully reinvested, 1994 to 2024, The broad market index fund won by a significant margin, $2.3 million versus $1.12 million from $100,000 starting points. In a tax-advantaged account with a dividend growth strategy, not high yield, the gap narrows to approximately $2.31 million versus $1.87 million. Still an index fund edge, but the difference is no longer transformative. In a sequence of return stress tests, modeling a 2007 retirement date with a 40% portfolio drawdown in year 2, the dividend growth portfolio, with its stable income stream, outperformed in the metric that actually matters for retirees: portfolio survival rate and income consistency across the 20-year retirement period. The index fund was wealthier on paper during the accumulation phase. The dividend growth portfolio was more resilient during the distribution phase. These are not competing strategies. They are tools for different phases of a financial life, and the investors who understand that distinction will, on average, outperform those who pick a camp and defend it. 3 decisions you should make based on this analysis. 1. If you're in a taxable account and you own high dividend ETFs yielding 4 to 6%, model your actual after-tax total return. Include dividends taxed as ordinary income. For many investors, the after-tax return of a dividend ETF in a taxable account is meaningfully lower than the headline yield implies. 2. If you are within 10 to 15 years of retirement, examine your current portfolio's sequence of returns exposure. Are you dependent on selling shares for income? What happens to your withdrawal plan if markets are down 35% in year 1 of retirement? Build a 2-year cash or short-term bond buffer before you need it. 3. If you want dividend exposure, prioritize dividend growth over dividend yield. A 2% yield growing at 8% annually becomes more valuable within a decade than a 5% yield growing at 2%. The compounding of the dividend itself is what creates long-term income security. The structural question I'm not able to close cleanly, because no one can, is this: we are roughly 3 years into an interest rate environment that looks materially different from the 40 years that produced the index fund's golden era. The historical data we use to argue that index funds win is generated almost entirely from a falling rate, multiple expansion regime. If the next 20 years look more like 1965 to 1982 than 1982 to 2022, the optimal strategy shifts. Not dramatically. Not toward abandoning index exposure, but toward a more deliberate allocation to income-generating assets with pricing power, which is a description of dividend growth investing at its best. The question worth sitting with: are you building a portfolio designed for the macro regime that was, or the macro regime that is forming? Most financial plans are backward-looking by construction. The investors who outperform over the next decade won't necessarily be the ones who picked the better asset class. They'll be the ones who understood why one outperformed and adjusted when the conditions changed. That's the analysis. Run your own numbers. Adjust for your account type, your tax bracket, your timeline, and your behavioral profile. The math is a starting point, not a verdict.